Hello, everybody, and welcome to the Dorsey Wright podcast for Wednesday, April the 15th. I'm Jay Gragnani.
And I'm Ian Saunders.
And April 15th is a day that I think most everybody recognizes as tax day. This year, however, April 15th is the day formerly known as tax day, as the federal tax filing and most state tax filing deadlines have been pushed back. On federal level, pushed back to July. In varying states, I know, here, Ian and I and the Dorsey Wright, most of the Dorsey Wright team being in Richmond, Virginia. The Virginia filing has been pushed back, not quite as long, so just May 1st. Nonetheless, we continue to operate in a market environment with quite a bit of volatility, and just that can be seen through looking at the point and figure chart of the S&P 500. And after seeing a very violent pullback, sell-off, describe it however you want to, since the February 19th high to the March 23rd peak, we have seen a similar violent rally back in the S&P 500 from the March 23rd lows. Most recently as yesterday, that the S&P 500 was bumping up against the 2840, up in the 2850 area. And, that is between about 2840 to up to really 2880 is a notable area of resistance for the S&P 500. It was previously support on the chart from August of last year, as well as October of last year. And also some near-term resistance from March. So that area in that 2840 to 2880 area is certainly an area that we will watch now as an area of resistance on the upside. Failing to get through that with the push yesterday. Obviously today, at least as we're recording this on the 15th, the market is down quite a bit. And quite a bit is all relative these days. I mean, the market's down about a little over 2%, and those types of moves have been, uncharacteristically normal for the market. And I mean, you go back and you look at just what we've seen since the market bottomed, and the number of quote unquote volatile days just continues to string together, and defining those volatile days as being days where the market either up or it's down 1% or more. And since the market bottom, there's only been one day where that has not been the case. And that was back on April the 7th, where the S&P closed down just under 20 basis points, down 0.16%. But otherwise, you look at the volatility is certainly still here on a number of different fronts, whether you're looking at just day-to-day moves, or whether you look at other charts of things like, say, the VIX as an example, is another measure of volatility in the market.
Yeah, absolutely. And I mean, the 1% plus or minus is what we are going to typically focus on in the research, as you mentioned there. But I mean, the VIX is pretty widely used across the industry, right? So coming in, we have the point and figure chart of the VIX, and we can see that reached heights as high as 85 here from a point and figure chart perspective, with that broad-based decline that we saw there at the end of March. Then begin to pull back from that high, moving all the way back down to 37 before having volatile movement in and of itself, kind of expressing that continued volatility. Fell to 38 yesterday, and with movement today is reversing back up into a column of X's there to 43. But if we look at the longer term moving averages there, I mean, it's good to see the VIX falling from those heights of 85 that we saw there in March. But in looking at the 150-day moving average, or even the 200-day moving average there, the VIX typically is going to hang around the low 20s. And so seeing it still at elevated position up around almost double the territory where it typically has traded, at least over the past, from a 150 or 200-day moving average perspective, speaks to the kind of continued volatility that we would expect based upon some of our other indicators. And one of those indicators that we would look towards is going to be Bullish Percent for the New York Stock Exchange, which we saw reach extremely washed out territory there in March and has since shown some significant upside. However, we've seen this chart continue higher up to 66%, and it's creeping up towards that 70% threshold. And then typically when we're looking at the Bullish Percent for the NYSE, again, measuring the percentage of stocks in the New York Stock Exchange that are on a current point and figure buy signal. This chart, we're looking at the 30% and the 70% levels as lines of demarcation. So falling beneath 30% is the period when we start to look for those reversals back up in X's. This chart fell all the way down to 6% there in March before reversing back up into a column of X's there at the end of the month. And has risen up to 66%. Again, we're looking at the 70% level as, okay, movement above that is when we start to begin to look for at least that potential for the reversal down into a column of those from there. Then again, we've seen that volatility that we from the perspective, whether it's from the S&P or from the VIX, displayed here in the Bullish Percent as well, which is akin to some other historical times that we've seen in the market there.
Yeah, it's absolutely right. I mean, you get up, the 66%, and as you alluded to, the weakness in today's market, you're seeing the NYSE Bullish Percent will come within about 1% of reversing back into a column of those, and that would effectively cause the defensive team, so to speak, to come back out onto the field. And given the volatility in the market that we've seen here recently, we've seen pretty quick and short-lived moves, specifically in the Bullish Percent. Right now, the most recent reversal up in that Bullish Percent came as a result of March 24th, and that came all the way down, or the low reversal, I should say, came all the way down on March 24th from down below 6%. Stayed in X's for about 8 days before reversing down for a short-lived stay in O's, reversed back up on April the 7th, and now we're coming really, really close to seeing that reverse back down, and that's certainly another sign and very indicative of what we've seen with the volatility that's taken place in the market. Nonetheless, with that coming close to reversing down, and also seeing likely to see a reversal down in the S&P 500 Bullish Percent as a result of today's action, again, the 15th. The S&P 500 Bullish Percent reached 90%. And what that meant, and what that means very simply, is that 90% of the stocks in the S&P 500 are on point and figure buy signals. And another way to think about that is 90% of the stocks in the S&P 500 are being controlled by demand. And that was a pure function of the rally across the board that we saw coming off of the recent market lows from back in March. And so you saw a vast majority of the stocks in the market participating in that rally back higher. There were obviously some did better than others, but really, when you look at these Bullish Percents and you think about them as breadth and participation indicators, that was the highest reading that we have ever seen in this Bullish Percent chart, as far back as we have daily data into the late 90s. Nonetheless, as a result of today, what that means is, and what we're seeing is this chart is going to reverse down from 90% as a number of stocks on the S&P 500 are returning to near-term sell signals. And that is certainly something that we want to pay attention to, nothing to ignore or shake a stick at. And, simply, again, just like 90% of stocks were on buy signals, what the way that number decreases is for those stocks to move back to point and figure sell signals. In other words, net new supply coming back into the market, which ultimately drives those prices of the stocks lower, causes those charts to get sell signals, which ultimately will cause these indicators to reverse down. So there's a number of stocks. There's about 11% of the universe, so almost 60 stocks as we're recording this right now, that are returning to sell signals in the S&P 500 today. And frankly, a lot of those stocks are doing so and returning to near-term sell signals within the confines of generally negative trends in the market. And so, that is something that you could even see when you were back on that chart of the S&P 500, just looking at the S&P 500 chart itself as kind of a um, picture of what has happened in the market, we've seen a lot of stocks that look similar in many ways to the S&P 500, where a lot of damage was done on the way down. Trend lines were violated. Numerous areas of support were taken out. The rally back recently caused some of these charts to get back to buy signals, and that's what ultimately causes things like the bullish percent to reverse up. And here we are still in an overall negative trend, and a lot of stocks are still in negative trends, but are returning to near-term sell signals. The S&P 500 itself has not. If we see a move to 2720, though, that would put the S&P 500 chart back on a sell signal. And so that will be, an area, that 2720 area to watch. And in terms of support, 2740 will certainly be an area of support to watch on the S&P 500 going forward as we continue to move into and mid-April.
Yeah, absolutely. And I think another picture here that you alluded to there as well is that when the S&P 500 is still in oversold territory, even with the positive recent movement that we've seen, and like you said, a lot of names are still going to be in that position as well. They've definitely not as oversold as they were. I mean, the S&P moved significantly far beneath 100% oversold, but still, even with the positive movement that we're seeing with the bullish percents at elevated territory, to see names still in the negative trend, still in oversold territory, does speak to that level of continued volatility that we may expect here moving forward. And we've seen that volatility reflected as well throughout some other specific areas of the domestic equity market. I mean, coming into the broader Dolly rankings, right? We have the 6 broad asset classes ranked there. The cash is still king, sitting on top of those asset class rankings, followed by fixed income, currencies, and the domestic equities is still in the 4th ranked position. And we've seen domestic equities asset class gain some buy signals over the past week or so, with the kind of near-term upside movement that we've seen, advancing up from just beneath 160 signals to its current position there at 177 buy signals, but still 10 signals beneath currencies at 187. And then cash and fixed income are both right around 260, with 264 and 263 buy signals respectively, so far beneath those still. So definitely seeing some near-term upside reflected from the signals, but we haven't seen the domestic equities, at least asset class as a whole, rise in those rankings yet, which speaks to that longer-term picture that's still going to be towards the negative side there. We have seen some areas, though, within the asset class that kind of in a reflection of this continued volatility, namely from the energy space there in and of itself. We saw the energy sector had been one of the hardest hit areas with the decline there in March, and had remained in the bottom ranked sector from the domestic equity sector breakdown within the Dolly tool. Was the bottom ranked sector there for quite a while, with a low number of buy signals there, and it's gained some ground. It's now moved just above consumer cyclicals with 92 buy signals, compared to 91 for consumer cyclicals there, but still solidly in the bottom half is the second to last ranked sector within that breakdown. We've seen some of this reflected on the recent chart of crude oil as well, with the longer term washed out position that we saw. The chart of crude oil moving down from a high in January at 65, moving all the way down to $20 there, with trading it there at the end of March, and has held that $20 support level. Looking at the CL/futures chart, continuous chart for crude oil here, held that $20 support level there, and recently returned to a buy signal with movement over the last week there at $26. However, it's reversed back down into a column of those, currently sitting at that support at $20, that multi-year low there. And so while it's not looking currently, at least with trading today, and again at the time of recording, that we're going to move past that to give a return to a sell signal at 19, that support is currently holding there, but still crude oil is in oversold territory as well, heavily oversold territory at 111%. And again, another chart to continue to keep an eye out there, as we see it at these multi-year lows.
Yeah, and I mean, obviously, there's been a lot of fanfare, a lot of headlines around crude oil, given everything that's going on with OPEC and Saudi Arabia and Russia earlier, and now most recently this past weekend with the OPEC plus agreement coming out, and an agreement to cut almost 10 million barrels, 9.7 million barrels per day from production. And so there's certainly been a lot of speculation around the energy markets, not just crude oil specifically. That is, it's frankly hard to believe that we're talking about crude oil at $20 a barrel right now, and with even the cutting of production, which doesn't go into effect until the 1st of May. With everything going on in the world these days, I mean, just the sheer demand for use of crude oil has plummeted, as the world essentially is basically in a either work from home or very, very limited travel right now. And so even the production cuts seemingly have not stemmed any declines in the prices of crude oil, at least right now. So we'll see how that shapes up. But we did see quite a notable rally off of the lows of crude oil. I mean, from 20 up to recent high of $29 a barrel. Also, a number of energy stocks rallied, and so they're certainly down at these levels, and you look at things so oversold, still well below trend lines. Oftentimes that traders might look at these as potential trading ideas. I would just say that it's certainly fine, and looking at whether it's energy or anything else in terms of a trading mentality when they get so oversold and begin to show some near-term buy signals off the bottom. The only thing I would say is just it's important to have a game plan if the trade doesn't work out. If you bought it because you thought it had bottomed and given it a buy signal, and it all of a sudden turns back around, gives a sell signal, hits a new low, then having a game plan to manage that trade, exit the positions from there, because we've seen this time and time again over the course of the past few years, really in especially in energy and crude oil, as energy sector has been a laggard for really the past really almost 7 years now. I think this is the sixth of the past 7 years that energy, out of all of the broad sectors, is currently the worst performing sector on the year. So energy stocks in general continue to be long-term laggards. Wouldn't be surprised to see trading bounces and that type of stuff within here, but nothing to suggest that we're seeing energy take over leadership positions relative to some other areas of the market. And you go back to that Dolly picture, and speaking of leadership areas of the market, the things that have held up really well in this year, not only on the pullback as well as the rally, have been the higher relative strength areas of things like technology, things like large cap core and growth. And you think about there's a number of ETFs out there, the Qs, the Invesco Nasdaq 100 ETF QQQ, that is very much a large cap growth index that has a very heavy weight towards the technology sector. And so that is one that has held up, while the S&P 500 right now is down about 12% on the year. And that's through Tuesday's action, so not taking into account what's going on Wednesday right now. The S&P 500 down about 12. The Qs is basically flat, down just 0.35% this year. And so that really speaks to the volumes of the leadership trends in the market. The iShares Morningstar Large Cap Growth ETF JKE down just 2% as well on the year. Again, the themes of large cap growth certainly being at play within the market there, and momentum strategy, momentum in general. Has held up well, given the technology, given the consumer services types of names and healthcare names that have held up pretty well.
Yeah, absolutely. I mean, you take a look at names like we were talking about earlier, like Amazon, right? I mean, that had has continued to demonstrate strength. I mean, it's been one of the stronger areas over the past year to 2 years, and is recently, I mean, with movement today continuing to rise. One of the kind of the loan names is showing some significant upside there, or at least some upside on his point and figure chart. We saw Amazon that came right down from a high there in February of 2176, right down to touch this longer term bullish support line. Down at 1632 and rallied after that, giving 2 consecutive buy signals recently in 1984 and reaching new highs there at the 2304, at least with trading here earlier this morning. So definitely still going to be some names out there that are from the fund perspective as well as from the individual stock perspective that have held up better, that are demonstrating strength. But again, in going back to that longer term Dolly tool, from the broader relative strength perspective, we still see the top end dominated by those defensive asset classes, namely cash and then fixed income. But interestingly enough, over the past couple weeks here, we've seen some rotation within the fixed income breakdown on the Dolly tool. Seeing more typically equity correlated breakdowns, your preferreds and convertibles, your high yield, your corporate bonds, rising to the top end of the fixed income breakdown there in the tool, with preferreds and convertibles maintaining the top position there with 64 buy signals. Given some of the recent movement from the Fed, that purchasing some of the areas there has created more demand, stabilized some of the fixed income market that saw some a lot of volatility in and of itself there in March. And with that stabilization, we've seen some demand return for those higher yielding areas, such as the preferreds and convertibles there. And you can actually use the Dolly tool to click on those respective breakdowns and bring up some potential ideas to look towards. And one thing you'll notice if you click on the U.S. preferreds and convertibles link is that some of these names are scoring relatively higher, but they're doing so with a much lower R risk, relative risk rating than the most of the broader, at least definitely the broader equity space in and of itself. So for instance, in looking at a fund like your Invesco preferred portfolio, ticker PGX, has fell with the volatility in the market from highs in February of 1525, falling all the way down to 975, but has since rallied to give 2 buy signals, returned to a positive trend recently there, movement over the past week at 1375, and then has risen to around where it's trading, or at least was trading with movement there yesterday around 14. A fund score of 3.97 with a positive score direction and a low relative risk rating of 0.50. So there's movement to the upside. You have some near-term support there offered at 1250. Could be some potential other areas to take a look towards as well within the broader Dolly fixed income space.
Yeah, that's right. And even, we've seen some of that movement within the fixed income space, Ian, picked up within some of the fixed income models, specifically the State Street fixed income model that we run on the website that holds 4 ETFs within that inventory of about 20 different bond sectors, has recently rotated back into the preferred ETF, given the strength within preferred. So, that's another area right now to look at for those of you who are using models. We're seeing, as you would probably expect, given the volatility, quite a bit of changes underneath the surface in a number of these models, especially within some of those fixed income models. So if you're following models on the website, be sure to have your alerts set. Be sure to check back on those model pages and make sure you're watching for those changes. Because there's certainly not a lack of activity in the market out there, and so as we always try to do is try to provide information via these podcasts for subscribers to the website. We produce a daily equity report as well as Monday videos out there, and so to the extent that you have specific questions, please feel free to give us a call, talk through any individual stock positions or questions, maybe potential questions about models. You can see our phone number right there on the right-hand side of the screen, 804-320-8511. In the meantime, as always, we certainly appreciate you joining us this week for the podcast. Please let us know if there's anything specifically that we can help you with, or any topics that you would like to hear discussed or perspectives on. And otherwise, hope everybody stays safe and healthy out there, and look forward to talking to you soon.